All right, here we go. We're just going to do a late one today, a quick live stream, give you a quick update, some observations I want to make, and I want to share with you a little bit of investing knowledge. And that's what we're going to do. So I'm going to roll the intro real quick, throw a banner up here. I was in a very important text conversation, which I feel good about. And yeah, so just a couple of things going on and get into a few things. The gist of it, though, is what kind of moves did you make during this, last 8 months of a tough market? It's really been a lot longer than 8 months. But let's say, what moves have you made so far this year? Have you made investment moves that you regret? Have you sold things that you now regret? Have you bought stocks that you're happy about? A little bit of both. And this is the kind of market that tests you, that messes with your mind, that F's with your mind, because it gets you to start thinking, I should be doing this, I should be doing that. And time and again, this is the one area here in investing where the fight or flight reflex really needs to go. And doing nothing almost every time is your best course of action. Let's roll the quick intro and we'll get into it. All right. Thank you so much for joining me. It sucks when I spill the water on my desk, but this is live stream and it's okay. It's not cable TV. And I knew that was a dumb place. I knew that was a dumb place to put a cup of water, but we're okay. Don't worry about the electronics all over my desk. All right, whatever. Let's just get into the show. All right. So, it was a basically flattish day. Nasdaq was up a little bit. The other averages were off a little bit. But listen, we had a big day yesterday. We had a big month in July, and everybody's looking for these little down days, like they mean something. Like, oh yeah, the market's down today. Well, it's all over now, and that's the thing. Everyone, not maybe not you and I, but a lot of investors are approaching this market saying the stock market right now. I'm not talking about the fish market, the real estate market. I'm talking about the stock market. Just to be clear, people, investors are looking at this and saying, or they're thinking, every time the market goes down, this is it. Now this is the crescendo, the crash that's going to bring everything to an all-time low and crush everybody and make everybody wish they weren't even born. And that's and that's how bad it's going to be. But those times really don't happen too often. I mean, yeah, during the Great Recession in March of 2009 was the we call it the generational low for the stock market. And even then, investors did not want to invest in the stock market because they thought it was going to go even lower because there's going to be another crescendo. And that's the thing, when you start getting into that head game that there's always another crescendo, there's always something to be negative about, it doesn't work. Okay. It has always paid to be an optimist when it comes to investing. And it's easy to be an optimist when you first get started. Okay. But then when you have to wait for your stocks to go up and when they haven't done anything, then or they go down, then the negativity creeps in and you kind of forget the reasons why you bought a stock, and now you're more like fear and flight instead of courage and hold, right? I heard an expression about real estate that you're not supposed to time real estate and then buy. You're supposed to buy and then time. And I think that goes for the stock market too. You buy and you give it time. And waiting for the perfect entry point, it doesn't. I have yet to see it work for anybody. Now, when the market's down, I could see buying a little bit. You're not waiting for the perfect point. It's one of the things that I do. Okay, so just people are waiting. to have an all clear signal. And when you have an all clear signal, stocks are already up a lot. You're probably at a peak of a new bull market. So here's an expression that I can't stand hearing, especially from educated people who are in the media, who do what I do. And it goes something like this: but we're not out of the woods yet. You know, it's the most useless thing I can ever hear. And it scares people into thinking that there's something imminent going on. And it's a silly expression. All right. It's like, oh, we're not out of the woods yet. No kidding. We are never, ever out of the woods, because there's always something to worry about. There's always a problem in the credit markets. Companies go bust, Wall Street shenanigans, interest rates rising, you know, uh, wars and other geopolitical events. There's always something happening, and there's always a thing. There's always a reason to say, well, we have to wait till we get past this. We have to wait till we get past that. Let's get past the election. Let's get past the impeachment. Let's get past the rising price of oil. Let another thing pass. Let's let the Federal Reserve raising its interest rates pass. There's always something that keeps us in the woods. And basically, the reason analysts or strategists say that is so they could say, I'm really bullish, but we're not out of the woods yet. So they're playing both sides of the fence. So this way, if the market goes up, they were right because they said they're bullish. But if the market goes down, they could say, well, I told you we're not out of the woods yet. I mean, the stock market can go down at any given day, and often for reasons that we're not even aware of. Like, we think we know why the stock market goes down on a particular day, but many times, 6 months, a year later, or more, we look back and we realize, we just found the real reason stocks went down. And it's often different than the reason of the day or the excuse of the day. And that's the kind of thing I can't stand. Now we have Jackson is out there. Hey, Jackson, how are you? Well said. Hey, man, thank you. Thank you very much. I really appreciate that. And thank you so much for joining me. I don't believe I've seen you around here. And if you're a new viewer, thank you so much. If you've been around a long time watching the show, thank you so much. I really appreciate it. And your comment is very, very welcome. I appreciate it. Even if you said I suck and I'm stupid and I'm not saying anything smart, I still do appreciate you taking the time. But in this case, it was a nice thing to say, so I appreciate it. And Jason is out there. Jason says, I bought a lot of tech and I'm down. Yes, you are. So let's make sure we understand. Let's make sure we're very clear here. Okay, stock markets have always recovered. Indexes have always recovered. Okay. By the way, you can't invest directly into an index, but you can invest into a security that tracks or mimics an index. So you individual stocks don't always recover, but indexes have always recovered. So you may have bought Roku at 700. I don't even know where it went right now, but you may have bought that much higher, and maybe that'll recover, maybe it won't. But my point of today's episode is, if you did buy it, let's say you bought a bunch of tech stocks that are down as part of your portfolio, hopefully you didn't take too much of a bite of the apple, because it was such a great place to be for so long that I think not only did investors' portfolios become all teched out because of the appreciation of tech stocks, but then people bought even more tech stocks on top of the appreciated tech stocks because they thought they were going to make even more money. And we see what happened here. I've seen this movie before. That's what I always say. Don't overindulge in one sector, especially technology, because when they turn, it's brutal how low they can go. It's like there's no end in sight. I've seen it before. Lucent was $100 a share and a blue chip, and I remember that stock went down to $1 in 2000. Like, that was one of the most widely held stocks that you could never go wrong with. It's kind of like, then Cisco was a stock that you could never go wrong with, and that's, we just have to be careful. And Jackson, great, thanks for having me. I'm a new viewer. Pleasure to have you, sir. Thank you very much. Make sure you and I are connected, if we're not already, on LinkedIn. And if we're not, I'll definitely be sending you a connection request on LinkedIn. And Okay, so but if you are down in individual stocks and you started to move your individual stocks, I'll sell this, I'll buy this, I'll sell that, I'll buy this. Probably hasn't really helped that much because even if you bought an individual stock, let's say a tech stock that went up, it's because you probably had one that went down. But the one that went up, well, if you just held on to the one that you sold, that probably would have gone up also because for the most part, the NASDAQ stocks, the tech stocks, they're really just moving together. Some go up or down a little bit more than the others, but they're basically all moving in unison. Okay. All right. So I hate when people say it's we're not out of the woods yet. It's a silly expression. It means absolutely nothing except that when you're on TV and you say you're bullish and you're afraid of being wrong and looking like a fool, you say, but we're not out of the woods yet. So this way you know, I don't know, protect protect yourself. You're calling both trades. It's like saying, well, the market could go up or down in the next 6 months, which actually is a pretty good call, right? If you think about it, yes, it's true. And so how about this? So here's my call. The market could go up or down in the next 6 months. And it doesn't matter. And I don't freaking care because I'm following a process of investing for the long term. And my outlook is very, very long. I'm very patient. And I have clients and stocks for well over a decade, 2 decades plus more. I've been in the business for over 3 decades. And I can wait literally forever for a stock to go up. And I'm willing to wait for a stock to go up. I don't actually check my portfolio much. In fact, I hardly ever look at my portfolio. I mean, I know where all the stocks are because I look at stocks every day. But I've made remarkably few changes in my portfolio. I haven't bought and sold and trying to get out of this one thing and trying to get into another thing, and that'll go up a little bit, and I'll sell it and go into something else that can go up and try to parlay, you know, one quick hit after another until I have a big bundle of money. It's just not something that is workable. It's not something I personally feel like I don't really have the time for it. I don't have the desire for it, and I don't think it's going to. I think it's actually going to increase my risk and lower my returns over time. That's what we like to say: time in the market, not timing the market. Now, if you do have some money that you want to try to time the market, jet in and out, I'm not knocking you. That's okay. And I have seen people do it pretty well. But I also know you shouldn't do it with your whole portfolio because it's too easy to be wrong. And you could be right 20 times in a row. All you have to do is be wrong once to really set yourself back. Let's take a look at how the world did. Okay. Sorry, my phone is beeping a little bit. I've got an event, believe it or not, I have to get to in like now. But let's just take a look at two things I want to show you. Okay. First one is Lyft. Uber, if you recall, it was yesterday, the day before, it was up a lot in one day, like 10% plus in a day. Lyft came out with numbers today that were not good, lower than expected, missed their numbers. The stock is up though in aftermarket trading. That is significant, and I'll tell you why after we look at Doordash, which is up almost $12 a share, up almost 15% in aftermarket trading. Their numbers were pretty good. The point I'm making, and I made this point yesterday, is that when you start to see these more speculative issues, Doordash, okay, Lyft, the more aggressive NASDAQ stocks start to go up. We've been talking about this with other stocks like this the last couple of days. Remember a few days ago, I went over stocks that went down. I'm sorry. The other day, I was talking about stocks that went up in aftermarket trading despite bad numbers or despite missing analysts' expectations. And the point I made the other day is a bear market is characterized as even when companies come out with good news, they still go down. And a bull market could be characterized that even when a company comes out with worse than expected news or an earnings or revenue miss, they still go up. Investors just find a reason to buy stocks. They always look at the positive side in the bull market. And that's what's happening. That's what's happening now. And that's why I keep saying we are in such a powerful bull market. Now, people say, oh, but it's off a little bit today. It was off on Monday a little bit. Okay. People are really just like so nitpicky. So the market goes down once in a while. Okay. In an uptrend, it happens. The trend is there. I could see the market, the overall stock market, the U.S. stock market, pausing for a little bit. I could see it. It's reasonable expectation to say it's going to pause, consolidate gains, go down a little, and then resume its upside. I could see that. I could also see it going straight up from here. What I don't see, what could happen though, what could happen is the market just goes back down and retests its lows. But based on inflation starting to come down, I don't know about you, but I'm seeing gas like 395, 397. Oil was down again today. What I'm seeing is inflation starting to come down, supply chain starting to heal, and the Federal Reserve looking like it's closer to the end of its tightening cycle than the beginning. Now, Fed governors have been coming out the last few days saying, no, we're not even close to being done with the Fed rate hikes. I think the Fed really wants to show that it's in control and it's taking its time. And but the Fed is basically saying if inflation stays high, we're going to keep raising rates. The Fed needs to regain its credibility. And if the Fed raises rates more, I think it's good for the market because it's credible for the market, credible for the Fed. If the Fed stops raising rates, it's good for the market. So that's a bull market when whatever happens is a positive scenario as opposed to a bear market. Whatever happens is a negative scenario. And that's what I see now. Let's take a look at a couple of things. The thing I want to highlight is not, just the Dow or the NASDAQ or the S&P up or down a little bit. Two things. Oil, okay? Oil is down to $87 a barrel. And I'm telling you, you're gonna see gasoline go under $3.50 a gallon pretty soon. All right. Follow the oil markets closely. And I've been buying gasoline my entire adult life. So I know what I'm talking about. All right. 10-year yield down to 2.69%. But the thing I really want to show you is the VIX, 21.44. We're almost down to 20. It's so close. And we see that go below 20. It's just, I think, a continuation of the rally we're in. And again, I think it's powerful. And I just don't know why other people don't see it, but that's okay. That's what makes it a market. Yields were lower across the board. Why? Why were yields lower across the board? Because inflation is actually expected to come down. I'm not just telling you I think inflation comes down. I'm looking at base metals and wheat and lumber, and a lot of prices are down on the year, not up. So we're going to start to see this work through the supply chain. But the 10-year is 2.69%. The 2-year is still at 3%. Now, why is the 2-year with a 3 handle? Okay. But everything else from 10 years to short term is a 2 handle. There's something odd with the 2-year. And it's just that investors basically are selling the 2-year or they're shorting the 2-year because they haven't decided if the Fed's going to raise a quarter point, a half a point, or 3/4 of a point at the September meeting. By the way, there is no August meeting. A lot of people thinking, well, they raised in July. Let's see what they do in August. There is no August meeting. The Fed doesn't meet every month. It meets 8 times a year. You should know that. Okay. So that's it. That's the show today. I hope you found this informative. If you have any questions that you'd like to ask me, certainly hit me up in the comments. I love hearing from you. And even though I'm ending the show now, I will see your comments, your questions in the comments, rather. And if you would, give it a thumbs up or a heart or a wow, whatever reaction is available to you, depending on which social media platform you're watching on. It helps spread the good word of the work we're doing here. And I don't do these shows on Friday unless something major happens. So hopefully you won't see me tomorrow. But regardless, I'll be back Monday. Thank you very much for joining me and have a great start to your weekend. Bye.